this is the last session of the day, so after us you can have a drink, so we won't delay you too much. We got a great panel though, so let's get into it. So on my right here is Mike Bucella. Do you want to quickly introduce yourself?
Sure. Mike Bucella, co-founder, managing partner of Neoclassic Capital. We're an early-stage venture firm in crypto. I'm on the board of a company called TerraWolf as well in the HPC Bitcoin mining space, former general partner of Block Tower Capital.
Anton?
Sure. Yeah. My name is Anton Kozlov. I'm the head of sales at 21 Shares. 21 Shares is a specialist asset manager focused exclusively on digital assets. We currently have about 10 billion AUM across 50 products, 50 crypto-backed exchange-traded products trading globally.
Hey guys, my name is Thomas Cowan. I run Tokenization at Galaxy Digital, which is a crypto-focused investment bank.
All right, so I'm Ben Schiller from CoinDesk, leading media company in crypto. And I've covered crypto a long time, like 11 years, and I was thinking back before this session about 2017, 2018, how there were all these RWA startups, or they weren't called RWAs at the time, and it didn't really seem to go anywhere, and then we had 2021, another big boom. It didn't really seem to go anywhere that time. So I'm just wondering what is different this time and why everyone's in this room now and why we're so pumped on tokenization. Thomas, why do you think it is different this time, and what are you excited about?
Yeah, so I'm excited for really the convergence of all things retail with the tokenization offerings that I think we're going to see TradFi really engage with. And what I mean by that is with the ETFs that we've seen, last year really brought exposure to the retail side that we hadn't seen previously. And then this year, I think we're really going to see the power of tokenization demonstrate what it can do for traditional financial assets. And we've already seen it with stablecoins. We're increasingly seeing it with tokenized money market funds. And I think over the next year or two, we're really going to see that transformation happen with on-chain debt and private credit and the like, just because it's a more efficient way to service debt, to distribute debt, and to just demonstrate the transparency that the technology can have. So I think we're going to increasingly see those two worlds that right now are quite separate increasingly overlap more and more to kind of demonstrate that overlap, and pretty excited to see how that unfolds over the next maybe 2 or 3 years.
So we were talking yesterday and outside about this kind of convergence between the institutional world and the retail world kind of coming together finally. How do you see that happening?
I mean, I think it's going to be one of those classic examples of, the technological S-curve where it'll feel like nothing's happening and then all of a sudden it happens all at once. And I think we're going to see right now a lot of traditional financial institutions are increasingly more and more interested in Bitcoin and Ethereum and other digitally native asset exposure, just because a lot of the on-chain lending rates are much higher on-chain than off-chain. So that'll be like a lot of the catalysts for TradFi institutions to jump in. And then I think a lot of the time they'll see that the underlying technology really has matured to a point where it can be utilized for RWAs. And so that transition from crypto native products to RWAs, I think we're in the early stages of it, and it'll rapidly speed up when we get regulatory clarity over the next 18 months or so.
All right, Anton. So you don't actually do RWAs at the moment, at least in this country, but you are heavily into ETFs. You're a major issuer. What lessons do you think we can learn from ETFs in terms of bringing people to RWA?
Yeah, that's a great question. I think the crypto-backed ETFs last year really proved that there's a great fit for retail with those products. They offer convenience, access, and they offer the regulatory compliance infrastructure that's needed, and they meet retail where they are behavior-wise, right? So if you consider retail, what they're currently doing, people go onto their self-directed brokerage accounts, they trade in their IRAs, their tax advantage accounts. The ETFs made it possible to access crypto within those accounts that they basically are used to using. So those direct-to-consumer platforms, those tax advantage brokerage accounts, that's really the channel to access retail most efficiently, and the ETFs have been able to do that. So I think for this space, for the RWA tokenization space to really evolve and really scale, to Thomas's point, I think a lot of the rules need to change, which is kind of already in progress. There's clarity coming. There's the Genius Act on the stablecoin side that's in the works now. But also there's going to be a bunch of other regulatory sort of tailwinds. But I think the ETFs are they've been a good lesson in terms of how do we actually distribute and how do we target retail. We need to meet them where they are instead of attempting to change their behaviors. I think that's a bit difficult to do. So I think those are the kind of the main lessons there.
So maybe education's important?
Education is vastly important. Also, if you think about sort of what retail kind of doesn't want to do, they don't want to receive complicated tax forms. They don't want to receive like K1s, right, in private investments. They don't want to deal with hiring like a CPA, a specialized CPA to do their sort of more esoteric niche investments. They want everything in a single window, kind of like a Robinhood experience, where you can access crypto, you can access stocks. Down the road, you can access tokenized private credit. Like that's the dream. I think that you have to meet them where they are. It's going to be tough to change their behavior, and you have to educate them. Also, the way it's currently done, I think, is with a lot of these sort of solutions coming to market, only available to accredited investors, for example, through various exemptions. They make the UX UI a bit clunky. There's kind of disparate platforms where you access the RWAs. Also, from a marketing and sales perspective, you have to comply with securities regulations, right? Like, so 40 Act products, you can't just talk about whatever you want to talk about publicly. You have to be compliant. So education is very important. There's kind of a way it's been done in the traditional space. And I think for now, we're going to have to kind of adapt. We're going to have to follow those rules instead of just, like jumping right into everything's on chain, and that's how we do it.
Mike, so how much are you involved in RWAs at the moment, and how do you see this road ahead for retail adoption of RWAs?
I mean, I'm all for it. I've been the biggest proponent of RWAs since 2017 when I invested in many security token projects in my angel portfolio that went to zero. I think the biggest difference is, Securitize was a pre-seed company then, and now they're working with BlackRock. I think I'm a capitalist at heart, so my whole view on what creates or what generates growth in on-chain finance or RWA is two things. It's for the off-chain world, arbitrage and borrow, right, in terms of what they're paying to borrow capital. And in the on-chain world, it's risk. It's can I get a better risk-adjusted return sitting in treasuries versus earning 7% on some native DeFi yield. So if you can marry those two worlds, which we've been able to, because I think Kevin Meow's somewhere around here, he was on earlier, he's at Steakhouse now, but effectively that credit fund that we created a long time ago, or a few years ago, was we were borrowing less than the US government because the markets weren't educated enough to understand what they were lending at, and we were bringing assets on chain that were significantly better credits than what existed on chain. And so that led to a aha moment for at least us and maybe a few others. But I think generally I get excited because as whether it's the Genius Act or the Stable Act or whatever form of regulation happens that allows on-ramps and off-ramps to proliferate, we are a creative enough industry to realize what is boring enough to bring on chain, like to bring capital on chain, and what is creative enough to be novel at some point in the future, and then kind of doing that all at once. So there's a lot of companies here that are doing very novel things, and unfortunately, many of them will not see the light of day because we're not there yet. But that doesn't mean it's all for naught. I think novelty and new forms of financial innovation and lending and structured products are a future that will exist and will be able to exist because of on-chain finance or RWA. But a lot of what we're going to do is going to be boring shit for a period of time, and that's what we need. Like that's kind of the.
Can you maybe put that into categories? I mean, what is boring and what is
boring
creative?
Shit is stable coins and treasuries, but it's worked really well, and we needed it, right? Because if you think about, we don't need treasury. In a crypto bull market, those, crypto native yields are north of 50%. perp arbitrage is north of 50%. You don't need this kind of, but in the doldrums of a crypto bear market, if we have a massive onboarding cycle, that capital hopefully remains on chain, and they can earn 3 to 7% in pretty boring stuff. That allows you to sit on chain and wait for the next interesting thing to happen, and that's important. You need to be able to fend off inflation, and everyone has their own opinions on that. But I think the boring stuff is an absolute necessity because it exists in the off-chain world, right? You can keep your money in treasuries or money markets or whatever it might be. If you can't do that in the on-chain world, then you're not going to sit there and wait for some interesting on-chain yield product. You're going to go off-chain into the traditional market. So I think the boring stuff is the foundation of what could be very interesting things.
Can you tell us what the creative things are that aren't going to work?
I mean, we've seen that. Everything's been financed. During certain parts of the cycle, you see everything financed. So this happens off-chain as well. Like, people try to create new forms of lending markets, and I think they're interesting and unique and niche and probably somewhat uncorrelated. So from things like whiskey and wine and art, and a friend Rob started this company, Rally Road, and they're doing fractionalized collectibles and cars and everything. I personally think that the future, the most novel and realistic new markets are going to be digitally native assets. So intellectual property to me is the most obvious area. It hasn't developed enormously off-chain. I mean, music royalty portfolios are becoming a big thing, but even the biggest are a few $1 billion in assets, so it's not huge. The fact that you can originate on-chain, you can basically build in and tranche, master rights, remix rights, whatever it might be between music and entertainment, and then create, basically you can build these larger portfolios of individualized line item NFTs of these particular rights. Those create new forms of structured products that you can service and structure on-chain, because otherwise you bring this building on-chain. You're managing an off-chain custody, an on-chain custody. Your custody costs are double. And unless your cost of capital is half, you're not doing anything to benefit anybody. So I think the idea is, if you can originate and service on-chain, you need a digitally native asset. That, for me, intellectual property is probably the most interesting thing for the next 5 to 10 years in RWA.
So just unpack what you mean by IP, because people out here might not know what that is, like Story Protocol, for instance.
Yeah, so IP is so Story is one of the, my fund's not an investor in Story, so I'm not pushing my book here. My partner was an angel, so I'm pushing his book. We've invested in some projects on Story to support the idea of IP. So it could be anything from, again, music and media rights to individual identity to very digitally native IP. So for example, Story, or a project on Story, it's called Unleash Protocol. They are working with Layer 0 to bring Solana, crypto native Solana assets, their intellectual property rights, over to Story to then manage and distribute. And so, I don't know, it's a big Solana NFT community. You guys, I feel like you guys are Solana degens. I'm not that big on it. Anyone have a Solana NFT community? Anybody? This is really a traditional.
So, pudgy penguins?
Okay, so pudgies, right, so abstract. I mean, that, for example, they're bridging over pudgies. So you can then take your pudgy, your existing pudgy, little pudgy, you can remix that asset, you can then offer to issue that asset to a media company and then generate return on that. These are things that have all originated on-chain. The data is originally on-chain. You can service the loan on-chain. You can structure the asset. You can create a structured product based upon a basket of these things on-chain. That's like a mortgage-backed security, but on-chain assets. That to me is, as someone who we built a product where we had to run dual custody, if we didn't have the benefit of cost of capital, it would have made no sense.
And you can put your own IP on there as well.
Yeah, you can create IP all day if you want.
Yeah.
Use ChatGPT. I'm sure it probably works great.
Okay. We talked a little bit about regulation before. Thomas, just tell us about that. How do you see the regulatory discussion, and how is that going to help you?
Yeah, I mean, I think just at a very high level, just the level of the conversations that we've had even a year ago versus today are the delta is wide, right? Like Galaxy's fortunately very well positioned to be able to kind of straddle both TradFi and crypto, and the conversations even a year ago were more us being more outbound with different partners, and now the conversation has very much flipped where we're now working with a lot of different players just because of the coming regulatory clarity, where more and more of the traditional financial institutions are really interested in this technology, and they look at it as more as inevitable. And so the question is how they jump in and what strategies they are going to use for not only day one, but longer term in a decade. And so that some of that regulatory kind of clarity is in some ways priced in, especially with, I think, stablecoins. People very much see that bill passing relatively soon this year, which I think could be material for stablecoins specifically. But also it means that that momentum will likely continue to increase for the market infrastructure bill more broadly. I think DC is DC, so there's always a big asterisk there. But I think getting that level of clarity can really be more material, and it means that a lot of the players that historically have understandably been hesitant because there were a lot of unknowns are now coming off on the sidelines and are really excited to engage in ways that we haven't seen previously.
So we're expecting this market structure bill, which is the big sort of kahuna everyone's looking forward to. We're thinking that's going to actually address tokenization?
Well, I think a lot of it is modeled off of the MiCA regulation in Europe. I think some of it is very focused on what is a commodity and what is a security. Other questions that are still kind of out there is kind of dealing with the more complex questions that DeFi brings up, just because of the nature of the technology. But I think it's a great start, and that's where the discussion should be. And so I think the question is whether we're going to get to a point where you can move from discussion to legislation and then get it across the finish. But I think what's important is now, crypto players and tokenization players are involved in the conversation to help inform the bill and demonstrate the technology can be used in a lot of novel ways, in many ways that Mike mentioned. And so hearing you talk about different financial products that are focused on IP, for example, the parallel, you can take that and make that parallel back into TradFi in a way that can be pretty fascinating and unlock all kinds of different financial assets that can actually bring the TAM up across the board in a way that I think people haven't priced in yet.
Yeah, I feel like that's the so I think the interesting part is we can evolve existing markets or make them more efficient, or both, and then we can create new markets. I think it's the creation of markets that's the more interesting thing. The problem is, or the barrier, I don't know, to retail, just to general adoption, is liquidity, which I think hopefully gets resolved with some of these legislations, although there's a huge amount of contention. It's very, very contentious right now between all the major players. So we're all fans of decentralization, but everyone wants to protect their fiefdom. So I think everybody has a lot of views on the existing legislation, and I think if it was passed in its current form, a lot of folks in the industry would be very displeased.
Talking about the stablecoin bills.
Yeah. I think there's a lot of discourse around market structure and the way it should be versus the way it is, and kind of the powers that be and the influence they have. And so I don't necessarily care. I'm all for more capital on chain, and then we can work with it while it's there. I think Trump coin was, by the industry, a bit of an embarrassment. We all kind of like, we're not too into it, but the reality is it onboarded almost 1 million, very much north of 1 million new wallets and a lot of capital. And yeah, people got burned, but a lot of that sits on chain. And a lot of the things I think I said this last year. Yeah. A lot of the things we're embarrassed of were the biggest onboarding agents, right? So yeah, we all want to be serious, and we all spent a lot of time, whether it was on Capitol Hill or in traditional finance, and we all want to be serious about the development of this industry. But the reality is, what works in a bear market are vices, and what works in bringing people on chain is tapping into those human visceral emotions and vices. And you kind of need to do some funky stuff to get enough capital, enough gravitational force around a capital base that you can do more interesting real stuff with.
Well, I think Solana is interesting in that respect. I mean, it was kind of dead after SBF, and look at the meme coin surge. It's really
And Solana was meant to be a payments chain. Like Solana was, by anyone in traditional fintech, like you talk to the smartest people in Silicon Valley fintech world, Solana was a payments chain. Always was, always has been, and still is. But what made Solana was meme coin mania. So, in the background, they've been working with all the major payments companies for since 2018. So how long is that now? 7 years? Jesus Christ. 7 years. But what it is today to the public is very much a function of meme coins and not payments.
So if it's the fun stuff that onboards people, what is going to be the fun thing with RWAs, do you think? That's a good question.
I mean, I think it depends. Just the one point on the meme coins I would draw out is back to the launch of different coins over the past, whatever it is, 8 months at this point, has demonstrated the difference in the technology and how far we've come since the previous cycle to now. The fact that you can get that level of throughput and that level of speed that otherwise we haven't in previous cycles has demonstrated that, it starts with meme coins, but there's no reason why that couldn't be translated to stocks, and that speed is noticeable, right? So that underlying technology is, well, demonstrated for a use case right now that is very much fun, is going to increasingly be used for, real-world assets. And so the question is, what is that first use case going to be? I think, frankly, like when I look at traditional equities, the experience that Robinhood has is pretty good right now as a user, right? So the back end might be quite complex with all the different players that work together, but the front end is pretty good. And so I think really for this initial next wave, it would be in places where there's clear lack of transparency, where there's clear settlement risk, where just the margin is much thicker. And I think, private credit is a good example of that. On-chain debt is a good example of that, where servicing the underlying mortgage-backed securities, for example, putting all of that on-chain and having that all be automated, it would be a material improvement. The question is how long that takes. But that's immediately where my brain goes, is a place where, where is the lack of settlement and where is the structuring costs the most, and that's likely where the technology will have the biggest impact in this coming wave.
I also think retail wants access to specific things that they, like for example, I have friends who are like, how can I invest in SpaceX, or some of the AI stuff happening, like OpenAI, right, private company, how can I invest in that? They're not accredited investors. Not everyone is a registered rep or has the net worth requirements. So for retail, I think that's a big unlock, is if you can basically get that stuff in the hands of retail. I think down the road, I could see this in one or 2 years, even potentially with the way things are going, especially if we get more tailwinds on the regulatory side. But basically, a Robinhood, for example, offering a tokenized share of a private, investment,
right,
like SpaceX, or so I think that's another kind of area that's going to grow and unlock the retail sector.
So Robinhood, which is a great example, they're just a distribution force, right? Like first of all, nothing's been more destructive to retail wealth than Robinhood, right? Like it's north of 50% of their volumes of zero-day options, which is an absolute atrocity for all retail. But they realize they have this enormous distribution. They just signed a partnership with Kalshi to do prediction markets, which is just a funny way of saying betting, right? And that is a regulated off-chain prediction markets to bet on real-world events. They're also, without a doubt, going to be partnering with on-chain, under-regulated but soon-to-be regulated prediction markets, whether it be Polymarket or a number of others. I think that is probably another area of RWA. Again, it goes back to like sort of, at the end of the day, the reason that people feel okay losing money in Robinhood zero-day options versus trading, I don't know, give me the worst meme coin of the last cycle. Not the worst, but give me any of it. AI16Z is the fact that someone can say it was a same-day option in Tesla. It's a real business. It's a real company. It is a way worse expected value than buying a single dollar of AI16Z, because market makers are eating every single dollar of retail wealth that exists on Robinhood. And to me, like, I think inevitably it comes down to distribution and the inevitability of retail to want to gamble. So RWA will be things that people can gamble on that makes them feel as though they're investing. And then eventually when you get hurt enough, you start saying, maybe I should invest in these, yield products. And maybe, first lien debt on a tier 1, geo real estate at 15% makes a lot more sense than me trying to predict if Tesla's going to run 5% today.
And I think one thing to add on to that is what's important is the experience to, this person using the Robinhood app, for example, would have no idea that fund that you're referencing is actually on chain and fully tokenized. They would just say, oh, wow, okay, this is much cheaper and now available to me in a way that previously it wasn't. And so that's kind of the long-term evolution is, when people talk about tokenized debt, I'm hoping at some point we'll just go back to debt because everything will be tokenized and we can just talk about debt again. But that's going to be a long way off.
I'm just curious when open source code becomes the biggest market maker in a lot of these markets. That would be ridiculous. I mean, that would be amazing. Like right now, for example, there's like a few projects that we know that are doing prediction markets in the game space. So like gaming markets, people that play MMORPGs, and then some sports-related stuff. And they have engaged bots to go out and market make. And it's effectively open source code. They give them a few dollars to go out and make markets so that someone can trade a few bucks on these things. I think in time, that becomes probably and if they are hopefully mostly open source and decentralized, we're trading against, I don't know. I don't want to go down that rabbit hole, but it's interesting to think about.
Great. Well, I think we better wrap it up. It's 5 o'clock and everyone wants to go to the bar. So thank you very much, Mike, Anton, Thomas. Thanks all for coming.